in their home, we often need to bring in these experts here that we have at the tables today. And I thought it would be a great opportunity to bring everybody together and talk about what is a very dynamic moment in kind of the timeline of owning real estate. So I appreciate you being here. I'm Brian Ladd with the Ladd Group over at Cascade Sotheby's Realty. And we'll start down with Wes Price from Price Fonk Co CPA. He knows many of you may know him. He's been in this town forever, and he has a lot of historical knowledge on what has happened in Bend, why it's happened, and his position with understanding the business and the tax side of it has been very educational for me, and I appreciate you being here. So we've also got, you want to say anything? Or?
I can't.
No. We've got Clint Edwards. He is the owner of Elev8 Mortgage. He's been doing mortgages for 21 years. There's a lot of people that are new to the mortgage industry, and to get someone that has a 21-year history doing the same thing is hard to find, and he's been a really valuable asset for us. And he just opened his own shop, Elev8 Mortgage, here 6 months ago? In January, so really excited. We got Erin McDonald. She's with Karnopp Peterson, and your specialty is estate planning, and which is obviously very relevant to the conversations here. She's helped me personally, and she's helped a lot of our clients, so she has a lot of great things to add. Scott Agnew is the Chief Investment Officer from Ascent Capital. What I'd like to have is just a two-way conversation. It's a small room, we're an intimate group here, and if you have any questions, just let's go back and forth and have a nice conversation tonight. And if you need to step out and grab a glass of wine, go for it. So first of all, to talk about what a downsizing event in real estate is, I think it behooves us to take a step back and talk about real estate in general and just some of the trends. I think 3 to 5 minutes to talk about what's happening in the overall real estate industry, I think will help put a framework around this discussion. This graph here is from 1998 through 2019. So we have an 11-year graph here. And what this shows is the amount of homes that were for sale at any one time. As you can see, in the housing recession, in the economic recession and the housing correction from 2007 to about 2010, we peaked at about 2,700 homes on the market. Right now, we're floating just about 1,400 homes on the market. So a lot fewer homes available. So that is about 50% down from the peak, but it's still about 40% more than our pre-correction inventory. So there was a lot of times in Bend in the late 90s, early 2000s, there was maybe 750, 850 homes for sale. Right now, we sit about double that. So
This is Bend?
This is Bend overall. Yeah, so we have the little bit less absorption than we saw about 15 years ago.
So, Brian, what do you attribute that 1,400 stabilized number to, as opposed to why is it not growing, if there's more demand, any of those kind of things?
So a couple things. One, we have less supply coming on the market. So even though we see booming Northwest Crossing, Tetherow, a few polished neighborhoods, if we actually look at the macro picture here in Bend, we're still only about half the building permits that we were back in the peak years. So there's a lot fewer homes coming on the market. The reason I bring that up is that I actually think that we should have more inventory on the market right now because sales volume is down. If you look at first quarter 2019, we're actually down about 45 to 50% over 2018. So there's a lot fewer homes selling. A lot of people are reaching this threshold where housing prices in Bend have just become so darn expensive they don't want to spend any more. They can't. They've reached their limit. They can't spend $1 more. It's so far outstripped their income that they just can't afford to spend anymore. But because there's so few homes on the market, we're at this kind of standoff point, and it's this odd standoff where the homes just are not selling as quickly, and so inventory has grown a little bit, but I actually think inventory should be more if we had a traditional supply and demand reaction that we've always had through housing. Traditionally, housing always had oversupply eras, then you'd have a housing correction, and then you'd have oversupply and then housing correction. But after the last recession, banks won't touch builders, right? And so there's just not enough homes coming out of the ground.
Yeah.
Does that help?
I was going to suggest that, is that this is a financing issue. Is there just flat isn't the kind of speculatory house financing that existed a decade ago. It got decimated. I mean, it was flat out decimated in that last downturn. And that, I don't know if I'll ever see it come back. You know, it'll be very interesting to see if it will.
Well, it's interesting because housing used to be any builder could go tie up a piece of dirt, go to the bank with a pro forma on how they want to do it, and they could go get a development loan, and then they could also go get construction loans to build those houses. And banks will not touch people anymore. Unless you've got 1.5 times the assets of the loan you're going to do on retainer at the bank, you can't do it. So private money is stepping in, but it's very expensive money, and it's causing an odd situation. There's not a lot of new homes coming out of the ground, and I think it's going to continue to be a problem. So average sales price, as you can see, we peaked back in 2006, 2007, but since the bottom, it's been a kind of a nice, clean recovery year over year. And last year we had about just under 7% appreciation on housing here in Bend. Now this was a stat that I pulled up that was interesting because there's a lot of talk in the market about an upcoming recession, right? The brown vertical bars, this goes back to about 1960. The brown vertical bars are recessions. And the line is housing prices. And what was interesting for me to find is that in the 4 of the last 5 recessions, housing prices were either flat or went up. So a lot of people correlate a upcoming recession with house prices are going to go down, and it's not necessarily correlated. Not to get too wonky, but the last recession, they were tied together with subprime mortgages and all that, so they both went down at the same time. Housing was the cause of the recession, but historically that hasn't been the case. But trends are changing. Here's 3 headlines that I pulled up today. So Forbes is saying housing will weaken further in 2019 and 20. Investopia, they quoted Zillow as saying they predict the next housing recession in 2020. And MarketWatch, they're saying we're absolutely at the perfect storm for some sort of housing correction. So despite that 9-10 year consistent recovery, change is in the air, and I think we just all need to be aware of it. Would you guys agree with that? But I still believe in housing.
You better.
I better believe in it. But kind of given the news and this forecast, I think it behooves us to pay homage to the fundamentals that are more important than ever, which is the proper use of leverage, not lending too much money. And when you look at these long-term historical rates right now, you can go get a loan for under 4%. And if you plan on owning a home for 10 or 20 years, it really doesn't matter what housing prices are today because the life of the loan, you're going to pay a whole lot less now. Keep your debt and income in check. And make sure that you have lasting power through any correction. Real estate is above its peak in 2006, and the only people that got caught in the recession were people that didn't have lasting power. And 2 or 3 years of a down income or a down market, they were forced to liquidate, and that's what caused a lot of the problems. So, that aside, and also real estate, I believe it's a 3-year minimum hold. A lot of people try to do it less, and I think that's kind of a fool's errand. But this is interesting. This was why I was talking about this applies to Broken Top. So not all real estate is performing the same. If you look at the top trend, this is average price per square foot from 1998 till now, with the peak in 2007-8. But if you look at the housing prices on $750,000 homes and up, which is the bottom graph, it's a whole different world. So when you look at $750,000 and up, we've actually only come up 40% from the low in 2010, when overall housing is up 240%. So upper end real estate is not as strong price-wise in the recovery as overall housing in Bend. And the other thing that I think is interesting to talk about is that just before I said that overall housing is not tied to recession, luxury real estate Kind of is. If you look back here in the early 2000s, from 2000, late 2000, 2001, 2 into 3, this was a recession, and housing prices on luxury real estate dropped very quickly. Was there a stock market correction in 98?
Yeah, it was.
There was. So, the headwinds that we're going into the next year of uncertainty with an election year, with a potential stock market correction, who knows, those are going to directly affect luxury real estate in Bend, and I think it's going to continue to tamper any appreciation, if we have any, on the upper end.
So in the data that you pulled to do the over 750, that's unlimited on the top side.
Correct.
So it's all over the place. Okay.
Yeah, I mean, if I put a total top end on there, it would be interesting to see if it affects it, but we don't have much housing in Bend above $2.5–3 million. It's such a small piece of the pie, but what's also interesting is how it can recover quickly. If you look at 2012-13, a price per square foot jumps $50 a foot in a month when all of a sudden people decide that the recession's over and things are good again. But that doesn't happen in a $350,000 housing, but luxury it can jump quickly, but I think that it's a different world. So, in Broken Top specifically, Lisa, do you have anything to talk about this?
Sure. So this is number of homes sold just in Broken Top, and you can see that way back in 2010, after the recession, the numbers started really increasing. But if you look at the top of the chart, 2019, 18, 17, you're seeing a little bit of a trend of a decline. Now, if we look at the very top line, 2019 annualized number, looks like we're going to do better than we did in 2018, but not as good as the year prior. So 2017, it doesn't look like we're on track to beat those numbers.
So that's the number of homes sold, and this is the days on market.
It's a pretty significant jump. If you look at that graph there, we are on a really steep incline with the amount of time that homes are staying on market. So many people want their home to sell within 30 and 60 days, and especially for the higher end market here in Broken Top, that's just not a realistic expectation.
So what are the number of days on the x-axis?
Well, so right now we're at about 275 days on average for a home to sell in Broken Top, and that's average. And it's actually, I don't even think that's quite accurate, because when a home is for sale and they can't sell it and they take it off the market and put it back on, it comes back on as zero. So, and there's been homes that have done that 2 and 3 times. So we're to the point where we have to accept the reality that to sell a house in Broken Top right now is often measured in months and even years rather than days.
It all depends on the home. If it's a single level home, boy, that's a high demand item right now. So, Hans?
But to your point then, if you're looking over the next 3.5 years of modest appreciation, someone who's waiting to cash in on that next 50 or 100,000, they might better take the opportunity now.
Quite possibly. Yeah, when I hate to make projections, but all the data is pretty clearly showing me, and I'd love your guys' opinion on this, that there is very little reason for luxury real estate to be more valuable, and everything over $750,000 is luxury real estate, to be worth more in 2 or 3 years than it is now. And that's odd coming from a real estate agent, but I think the reality of it is I just don't see a lot of factors that are supporting it, whether it's economic growth or, because long term, even though interest rates are low right now, and they've been low for way too long, but when you look at the long-term economic and debt of the U.S., interest rates are eventually going to have to go up to attract capital, right? And that's going to continue to push, the cost of ownership is going to go up as well. So even if housing prices remain the same and you pay 1 point more in mortgage a year from now, that costs 20% more to buy, or your monthly payment is up 20%, even if housing prices are flat.
And if you decide to wait 2, 3, 4 years, in the meantime, those interest rates go up, your buying audience is collapsing at the same time.
Exactly.
Truly.
Do you think there's any influence by luxury home owners wanting to build their custom home versus buying an existing luxury home?
Well, that's a good point. I do think there's some of that, because at a certain point, people want what they want, and if they're going to spend $1.5 million, what we don't have is a scarcity of individual custom lots, especially in Bend. I've sold about 250 home sites in Tetherow over the last 7-8 years. And there is ability for someone to go replace it. Right now, the trend is that construction is so expensive and timelines are so long that it takes 18 months to build and it's pretty expensive to do. But we're not in a closed market like a Boston or an urban center where you don't have the ability to replace it. You can. And what was interesting is that I just did a study for another homeowner of mine that we're selling. There's actually a negative ROI on ultra custom homes. I did a study that on homes above $2.5 million in Bend, the average sales price to what they actually cost to build it was about 65%. So, because, you know, at a certain point you get outside of the mean of a market. You know, the mean price in Bend is $425,000. And when you get to $4 million, you're 10x the mean. You know, that's like in New York trying to sell a $100 million apartment. It becomes highly arbitrary and you're not going to get your money back. You can put in all the crazy countertops and, you know, columns from Rome that you want, but you're not going to get the money back. And we just don't have the depth of the market there.
Over customization.
You can definitely over customize a house. And, you know, once you, my thought is that once you're 3x over the mean, you're not going to necessarily get positive ROI on any customization that you put into a house.
Yeah.
I mean, we all saw the home that was listed in Broken Top for $15 million.
Yes, we did.
That sold at 3 point.
Well, that was with the arch.
Yeah, with art. But you know, from the research I did on that home, I think the cost basis in it was 7 or 8.
Mm-hmm.
So that one sold at 40% of input to the house.
And it's been on market for 2.5 years.
Yeah. So, and I'm not necessarily saying you can't do well in upper end real estate, but I think it becomes highly discretionary. So, with the real estate aside, thanks for hanging with me on that. Let's start with kind of the why of downsizing. And I think before we get too involved in estate planning and all that, I think it takes, you know, it's good for us to take one step back and kind of talk about why would we even consider doing this complicated move that is going to disrupt our life, disrupt our loan, disrupt our estate plan, and I think it helps us understand. So by understanding the why, we can better understand what we're doing, selling a home, and how we're doing it, the process, the divesting of the assets, and the estate planning. So I'd love your input on this as well. Some of the ideas that I came up with were lifestyle changes, right? Maybe activities become more important than your home size. Your maintenance and upkeep. Toilets.
Washing up.
Do I hear of pine needles?
Pine needles.
Raking pine needles.
Raking pine needles, yeah.
Access to healthcare. A lot of people are very concerned about that. House needs, future house needs have changed. Maybe a one-level design, space for in-home care, space for family that are moving back in. And diversification of assets and retirement. I think this is something that does anyone have any input on that right now? Just how housing can become an abnormally large size of your, you know, investment strategy in retirement?
Yeah, no, it's, you know, you always want to have a balance, right? You want a balance of liquid assets, and then you have your home, which is typically very illiquid relative, certainly in Broken Top.
Yep.
And so if you become oversized or, you know, over allocated to your personal real estate, you know, eventually you could run into a liquidity crisis. Or as he was talking about, maintenance and needs of a large home don't go away. They tend to go up as the home ages. So, you know, that's where we see plans go sideways, is where all of a sudden your core cost structure that you had 10 years ago is now 15, 20% higher than it was then because of deferred maintenance, roofs, furnaces, you name it. All of a sudden these costs start building in, and then your financial plan begins to go a little sideways.
I also like to look at the primary residence exclusion and looking at the income tax or the deferred gain on the house as an asset. And as a couple, you can avoid paying capital gains on $500,000 when you sell your primary residence if you've lived in the home for 2 of the previous 5 years. And so as that amount grows and grows, there may be a play to cashing out on that house and buying one of equal value or lesser value, but avoiding that, and then the clock starts ticking again on a new 2-year period for the primary residence exclusion. So there's some income tax planning opportunities when you're looking at your assets and the diversity of your assets, and also the gain and appreciation in those different classes.
Yep, that's a good point. Income and expense planning, HOA, maintenance costs, taxes. Scott made a good point in our discussions prior to this, is that not every downsize is less expensive. Some of these new homes have higher property taxes. You got to keep that in mind. A lot of these have higher HOAs. Sometimes you get the benefit of those higher HOAs that fully upkeep the home and things like that. But it's not always necessarily just because the home is less expensive that it's going to reduce your monthly spend, especially with some of the tax laws here in Oregon on how much a house can appreciate or how much the taxes can go up every year. So that's something to definitely keep in mind.
Yeah. Moving into a newer, smaller place can actually be way more in property taxes. It's a weird correlation, and it's not right, but it's the way Oregon's set up. So one thing to always check out when you're looking at the next place, look at the property tax bill. Because you can be going from, even equal value and double or triple your property tax bill. So you just have to be cautious, because the newer stuff in particular is valued at a current number, as opposed to, a home you've been in for a long time. It can be valued at a much lower number on the property tax rolls.
So is that a blend of market value and sale price, or is it?
No, it's weirder than
It's
that.
weird.
No,
It's way
if there was a straight up way to be able to correlate it and calculate it, it would be a lot easier. In what it really comes down to, just go ahead and go on the assessor's website for wherever it is, look up the address, and look at how the property tax value has been changing. If it's locked into the 3% increase and it's below what you would pay for it, so below market, that's a good correlation. There's a lot of homes, though, that because of the way the recession hit, the market value came down and matched up with the TAV, the taxable assessed value, and now they're in lockstep. So the market value and the taxable assessed value got synced as a part of that correction, and then all new construction is on a brand new reset. So.
And all property has a maximum increase of 3%, 3% a year.
Yeah.
But there's two things. There's real market value, right, and
Yes.
and maximum assessed value.
Yeah.
And those fluctuate independently, and then it's the lower of the two.
Right, that you pay tax.
And it all depends on, so they even have a website on the tax assessment website, or the tax assessor's website, and if you watch it, it's still not clear to you. And I should be in the position of being able to explain it well, and I can't. So it's a case-by-case basis.
Right, you just need to check it out. That's the most important thing.
Go
Just
to the
don't try to figure it.
assessor's website.
Exactly.
Yeah.
Dial, Deschutes County dial.
Dial.
Yeah, and part of this was the timing of when subdivisions were created, like Broken Top specifically. Your area, because of the timing, has much higher property taxes to similar, I mean, I went through it personally. I was looking in 2011, and homes in Broken Top still had taxes in the 10 to 12,000 on a 5 to 600,000 home. I buy in Southwest Bend, I buy a $500,000 home, my property taxes were $5,800, so less than half. So it's you almost can't figure it out.
No, and it's not fair.
No.
You don't even try to think fair. Just check out the numbers and then just go from there.
Well, it was a ballot measure, right?
It
And
was
every
a
time you try to legislate with ballot measures, it screws everything up, but anyways.
Yeah. The guy who actually got those passed by initiative petition ended up in jail.
Yes, that's true.
Sizemore.
So if we know the why of what we're talking about here today, I think the next step is, what are we doing? The selling or downsizing your current home, and I think that's where the expertise up here is going to really help us. And I think to start with is we need to remember that the role of a home changes over time. In your peak earning years, it's financial security, it's for family building, it's for wealth creation. But then as you near retirement or in retirement. It's more about security and functionality. So kind of the purpose of that home changes, and I think we need to remember to, it's like reallocating an investment portfolio. To reallocate what that home is to you over time is important to do. Otherwise, you find yourself in something that just doesn't suit your needs anymore. And that's what my next statement was. Make sure that the home serves you and you're not a servant of your home. It happens. It happens a lot. And what happens is a lot of people aren't proactively thinking about this, and they're in their home serving their home for 10 or 15 years before they finally pull the plug and start their life again, and they're like, why did I wait so long to actually get in charge of this again? Here's a point that I brought up last time we talked about this, and Wes caught on to it a lot, is your primary residence is not an investment. And a lot of people don't like to admit that. And I think everyone kind of lumps all real estate together. I would say that your primary residence is an asset at best that can, appreciation will hopefully offset your maintenance costs and your taxes and all that. But it's not an active investment vehicle. And when you start to talk about your retirement years, how you need to figure out how much you need as active investment, and your primary house doesn't count. Right?
It's part of your estate, not a part of your investments.
And then the next step of that is I actually think it can become a liability, because I think if you have life disruption, medical event, you need to move to go help family, and you're in a down cycle, housing is quiet that year, that winter, whatever, it can become a pretty significant liability in your life. And I'm not saying we shouldn't own homes. I think we just need to recognize it for what it is in that part of your life. And Scott brought up a comment here about being proactive and reactive in this process. I think that's a really important thing that is often not discussed. And if you're proactive in this downsizing event, you can take control, you can involve your team, and you can plan out the steps. But when you have to become reactive, it feels like you're chasing something down a rabbit hole and you just can't quite catch up. Do you guys ever see that? Are you brought in before or after the downsizing process has started?
We're always brought in after. It's when the crisis is all in motion, and then you sit down and try to sort it out. I think that Brian's bringing up a really, really good point. Is that if you put some forethought into running yourself through this process, you can at least vet out most of the downside things. If you just get into it, okay, we're moving to Cave Creek, Arizona. Okay, and the time that you start involving some of your financial and or planning process and team is you've made an offer and you can't get your place sold up here.
Right. There it is.
Then now all of a sudden you're in a critical point, when the reality is you just have to let go of the one thing, which is moving, and then figure out the plan B and put things in priority and just kind of reassess what are those priorities that we're looking for, in making whatever that transition is.
Well, Wes and I work together with clients. Wes and I have worked together with clients where they're making decisions about where they're going to live, and we'll help look at the income and estate tax consequences of making those decisions. So that's a way that we could be involved proactively.
And often, you're going to need some new liquidity sources in that transaction, depending on how you're structuring it.
Right.
So we often get the call during the worst parts of the market environments to all of a sudden need liquidity. Or on the flip side, there's going to be massive tax consequences to create liquidity from a portfolio. So the more time we have to create that and work with the CPA to minimize that impact, the better off the structure. And I also point out to Brian that when you're retired, getting a loan, well, you can it's a lot more difficult. They don't look at assets, they look at income.
Right,
They
yeah.
want to be taxable.
Yeah, when you're qualifying for a loan, if you, and that, actually, there's some changes to that.
Good.
There are some new loan programs where we can use assets for income, but for the most part, it's debt to income ratio.
What did you just say? Assets for income?
Yeah.
Wow.
So, a lot of the, going back to some of Brian's charts on increase and decline in the markets and the subprime and all that. A lot of that was driven towards, or by loans that were, the guidelines were basically if you had a social security number and you could read, you could get a loan.
You were warm.
They haven't gone that direction. The pendulum swung completely in the other direction, where for years it was really hard for people to qualify for financing. It's swung back. It's not hasn't swung back completely the other direction, and there are some realistic, really beneficial changes that have been happening with the financing side of things, to where we can qualify on bank statements now. We can do some things, but from a retirement or a standpoint, one change that's recently occurred with Fannie Mae and Freddie Mac is that they do allow you to generate income on paper with your assets. So if you are qualifying on Social Security, pension, annuity, whatever, interest income, those sort of streams aren't quite there to get you where you want to be. There is the ability to take some accounts and use those on a paper calculation. You don't have to actually use them, but from a paper calculation to help you qualify. So there are some things that are actually that make sense for this discussion for sure.
Okay. So downsizing often occurs in the reactive fashion, and you're subject to divesting, like you said, creating a liquidity event and off market. It can be in an off market time. Housing cycles are not only the big 10-year swings, they're annual. If you look at the sales price of a home, the same homes in April, May, June, they sell for about 8% more than they do in November, December, January. And it's every single year it's like that. So, even just planning 6 months ahead and allowing you to sell in a spring, summer market rather than a winter market, there could be an 8% delta even in just that, in addition to looking at the bigger macro trends.
Is that a local trend or is that national?
Every data I've always seen, it's pretty consistent across the nation. I mean, if you look at markets like Phoenix, I'd be interested to see if it has less of a time. But Bend is absolutely, it's about an 8 to 9% run every single year, just consistent waves. Like Scott said, this was a quote Scott sent me earlier, and I'm gonna make you live up to it, where he said, "Do it sooner than later." We've seen it become more difficult financially, mentally, and physically over time for everybody.
Yeah.
Stand by that?
Yeah, absolutely, because you figure that you're physically, consolidating. When you're downsizing, you're getting rid of a lot of furniture, potentially clothing, old crap. Yep.
The stuff your kids don't want.
Yes. Yeah, that's the other thing.
It's in your.
It's everything. Exactly.
So being able to both proactively participate in the process makes it a lot less stressful, because otherwise you're having to reach out typically to your family members, trying to bring them in town to help with the process, and that just magnifies the anxiety for everybody.
Yep. So here's another point I think that's worth discussing is, do you sell first? And a lot of people get hung up on saying, well, I'm excited about going and buying the home in Arizona, but I'm not ready because I haven't sold my home first. One thing that I think we should talk about here is a lease-back situation. We've found it successful in quite a few circumstances where we market and sell a home subject to the owner being able to live there for 3 or 6 or 9 months. And it often works out, because when someone goes to buy a home, some people need a home right away, but when we talk luxury real estate in Broken Top, it's often they're here in the spring and summer and they don't need to be here for 6 months anyway. But if they can buy it now, lock in their mortgage, whatever, and you rent it back, it does two things. One, it frees up all your capital to go buy that next home, and you rent it back at a market rate rent. But it really takes the risk factor out of it, and the buyers love it because they know the tenant that they're getting. If they're buying your house, it's obviously in good condition, and you were the one who put it in that condition. So it's not like they have to bring in a random tenant to help them hold that asset. So to assume that you have to sell out day one on selling a home is just not the case. We've been able to get around that quite a few times. And that's been very helpful for people. Let's go to financing just a little bit. We alluded to it, but What are some of the ways people can get financing to kind of make that move for interim financing, reverse mortgages, things like that? You made a reference in a note here about their down payment source is often trapped in the equity of their home. How do they access that?
Right. We run into this quite often, man, and fortunately for a lot of people, there is the income to help to go out and purchase that new home without having to sell their current residence to qualify. And as Brian mentioned earlier, the qualifying for a loan is less asset driven and more income driven. So there's that picture, but then there is assets required. So if you don't have the liquidity outside of your home to make a down payment on the next phase, then you need to think ahead and plan on how to do that. Home equity line of credit, setting that up and just having it sit it with a zero balance, ahead of time is a great way to have create some liquidity in your equity of your home. The idea of doing a cash out refinance while your home's for sale is very hard to do because the underwriting guidelines say you can't pull cash out while your home's on the for sale, and even it has some lingering effects if it's been on the market for within the last 60 days, or whatever it might be. You can't pull cash out to do something different. So you really do have to think ahead, and I think that is probably one of the from a lending perspective. There's a lot of things we can do with income to generate ways to qualify, but it does the asset piece is a real important one to think ahead and really plan out with your financial planners and and know that you have some liquidity. I mean, depending on your loan size of what you're going into, you can get into it with very little money down, as low as 5% down. So that's a strategy. If you have some liquidity in order to get 5 or 10% down on your new purchase, then you can qualify for that. And then eventually, when you sell your current residence and take the proceeds, you can pay down that loan and have it recast or re-amortized and lower your monthly payment for the long term without having to refinance that. And that's something that we always try to vet out with folks when I'm talking to them is what are your long-term plans, what are your goals, so that we can structure the cost of the loan and we can make sure it's with an investor that will allow that recast and that re-amortization of the payment. Because you don't want to go and do another refinance 6 months or a year down the road to now get your lower payment that you're going to have for the life of the loan.
So those are good points. Now, what about reverse mortgage? Is that a dirty word to you? I'd love to hear everyone's opinion on that. It's a touchy one, and everyone has an opinion on it.
Before we move off of what you just said, there is one rule change in the tax laws on HELOCs, the home equity line of credit. It's not deductible interest anymore. So if you have an existing one, it's no longer deductible. If you get a new one, it's no longer deductible. So you need to make sure that the economics of it work out like you want to, and it's because it's a pure economic thing to be able to look at using a HELOC as a temporary loan to bridge over. Right. But it's still a good tool. You just have to know that you're not going to get any extra little penny out of deducting on your tax return.
Well, Wes, while you're talking about that, let's talk about the 2017 tax changes just a little bit with your deductibility of your mortgage interest.
Yeah, that used to be 1.1 million. In 2017, you could have a mortgage and combination HELOC for 1.1 million and deduct it all. Now it's 750,000 and zero on HELOCs. So that's a pretty substantial downplay. But what it does do is it helps define what Brian's talked about for the luxury home market. The Feds picked it at 750 also. Is that anything above that, they consider, you don't get the benefit of a tax deduction for it. So
further headwinds for
further headwinds.
luxury real estate. Okay, so reverse mortgage, I don't want to digress. We could talk about this for a half hour, but what do you generally feel about a reverse mortgage for, retirement and how it affects the financial planning for your retirement?
Maybe interested to hear your perspective.
Well, from for a long time they've had a bad rap, and rightly so for a lot of folks. And a HECA mortgage or reverse mortgage is not for everybody, for sure. But it can be a useful tool, and there are different ways to utilize that, both from a fixed payment or fixed annuity to a home equity. They have home equity lines of credit within those, or a combination of both. But it can be used for purchase. Typically, you'd be looking at around, depending on your age, they are strictly age-based. I mean, if you're 62, you're going to have to put more money down than somebody who's 72 or 82. But typically you're looking at somewhere around 50% down on the property. And in theory, you could put 50% down and not make another payment on that home for as long as you live there. They are non-recourse, so any heirs that take it over are if the property ends up upside down in a weird market, the heirs are not responsible for the difference. They are insured by FHA. And they can be a very useful tool. They're not the cheapest loan out there, and they don't have to build interest. The idea is that if you don't make a payment, that interest just accrues to your principal balance and grows and chips away at your equity. You can make an interest payment and not have that happen. But when the time comes, if there's a financial hardship and you can't make the payment or don't want to make the payment, you're not required to. So they can, from my perspective, I don't think they're a dirty word. I think they just need to be considered thoroughly from all parties involved, including the heirs and the family members with it, so that everybody's on board and knows what it is. Because I think that was a lot of the problem before, was they weren't explained properly, they weren't monitored, and they were exploited, I think, by those who were originating them. And it multiplied by with all that into the dirty word that it seems to be with a lot of folks. So.
Yeah, I have a stronger opinion than that. No, it's because I think there are moments where it might be a useful tool. I actually think that 20 years from now, people are going to view this as the most giant land grab that ever happened. I think the investor community that is behind reverse mortgages are going to end up owning a giant amount of real estate and have a very low cost in it. And they're going to resell it to all the rest of us and make a shitload of money. But I still think there's not, it's better because of the regulatory stuff and having the FHA backing in it. But the concept is still identical to where it was, is that you're giving up your real estate, and if it makes sense to give it up, then that's a different decision. That is a purely economic decision for a couple or a family to be able to make to take care of their loved one. It is not an investment decision. It is purely based on turning that asset into some form of cash.
Right.
And I think if the decision is made around that criteria, then there's still a useful tool potentially in there. But if somebody's just kind of cruising along and you're doing okay, I think they're a tool to stay away from.
And
find another way.
so you think it's more on the things you didn't plan, you have a liquidity event where you need capital right now, you didn't downsize, then this is a backup, but it shouldn't be.
It should not be. I don't
Should
think
not
it
be
should
a primary plan. Great.
But that could change. The regulatory environment, as Clint just said, has changed dramatically in the last 3 or 4 years. Prior to that, it was still pretty Wild West, but now it's more clearly defined, and there is a valuable tool for the right moment. But as a primary planning tool, I still like them.
Okay.
So.
Yeah, well, I would like to add one thing is you can't, I don't want to sound like I'm in defense of them at all, but You know, as long as you make your taxes and insurance, there's no way they can take it away, the home away from you, which is a common perspective of it, is, oh, I'm gonna lose my home, or my heirs are gonna lose the home. You know, there's, as long as you're paying the taxes and insurance, keeping that up, and as long as you're living in the property, which is a requirement, there's no way that anybody can take that home away from you, regardless of the equity position in it, even if it's upside down, so.
But if you've gotta go to assisted care or something like that, if you're of that age.
True.
I'm
Then
way
you-
away from that, but.
Yeah, then you have a
But
certain
then
time
you
frame
have to,
that-
you've gotta sell.
Yep, exactly,
Right.
yeah.
And
Or
then,
refinance, I mean, you know, it doesn't prohibit you from, you know, somebody, whether it's you or your heirs, you know, or whomever, refinancing that loan. But assuming that, yeah, that if they're in that position, potentially it would be a sale position at that point.
but it brings it all to a head in a very short time frame
Yeah,
where you have to make something happen.
right.
Okay, so I don't want to go on too much longer, but with Aaron's expertise here, I want to talk a little bit about estate planning. And I think there's some valuable knowledge that would be good for us to talk about. How do you feel about estate planning in different jurisdictions with different tax implications and, you know, selling here, moving to Arizona, California to here, you know, how would you address some of those issues with downsizing?
Yeah, so, I mean, there's a couple of things that come to mind when we're talking about buying and selling real estate from an estate planning perspective. So, first and foremost, if you've done estate planning, typically the person, the attorney that you've worked with has looked at how you hold title to your assets, whether it's your bank accounts or your real estate. You may have specifically bequested an asset in your estate planning to a specific beneficiary. So when you're buying and selling real estate, you need to make sure that you're being consistent with your planning. Lots of people in Oregon use revocable trusts as a way to hold their real estate, and that's a method of avoiding probate on the death of one or both of the owners of the property. And so if you sell an asset, a real estate asset, and you buy a new home, it's important that you do it in the name of your trust. So I'm always looking at, when I'm working with new clients, how is their real estate titled? Is it consistent with their estate planning? Any changes that they've made, are they impacting the beneficiaries? So what happens on the passing of the individual? And then in terms of jurisdictional differences, there's tons. Typically we're looking at, from a tax perspective, differences in estate tax. So Oregon has an estate tax. A lot of these states that are nearby do not. California does not have an estate tax. They do have income tax, and so you trade one for the other. Or we have high income tax too, so maybe you look at Arizona. So that's part of the analysis that Wes and I will do together with clients. But we're also looking at community property. So I work with, as Bend grows and a lot of people are migrating in from California and Washington and other urban areas, looking at community property, looking at the changes in tax planning, making sure that it's reflective of being in Oregon. Those are all really important. And a lot of that is really critical in the first year or two that they move into Oregon. So I would say that the flip side is also the case if you're moving to California or somewhere else. Making sure that you establish a relationship with an attorney in your new location is important, just to make sure that the planning that you've done is still good. Does that answer your question?
Yep.
Kind of what you were thinking?
Mm-hmm.
Okay.
Yep, absolutely. I mean, we could go down any one of those rabbit holes, but
Yeah.
I think for this
So
purpose.
that's kind of high level.
Yeah.
How many folks in the room know that Oregon is a separate property state versus community property?
What does that mean?
One.
See, that is a very interesting distinction.
Well, it's actually, we're a quasi-community.
Oh, yeah, no,
property,
I
Yeah.
get that. And I
So
get that.
separate, so this comes down.
I'm gonna take notes.
There's an income tax basis issue.
Right.
Let's say my husband and I own an asset and we own it jointly and we live in Oregon and I pass away, my share of the asset receives an adjusted income tax basis. We talk about a stepped up income tax basis. So my share of the asset receives an adjusted basis. So if my husband goes and sells it the next day, he's not gonna have to pay capital gains on the portion that's attributable to my estate. Okay, so that's an adjusted income tax basis. If you take that same asset and we live in a community property jurisdiction and it's a joint asset and I die, the entirety of the asset receives an adjusted basis.
Not just half.
So even his half, so the whole thing receives an adjusted basis. So when we're working with clients that move in from Washington, California, Idaho, right? All the states around Oregon, Alaska,
Nevada.
yeah. There's a whole host of them, Arizona. So that's a critical part of the analysis is how are we treating your asset? Are we treating it as a separate asset or a community property asset? And Wes is right, Oregon is a separate property jurisdiction. However, our statute, in an acknowledgement that we're surrounded by community property jurisdictions, allows us to continue to treat assets brought in from a community property jurisdiction as community property. But you need to do it pretty quickly after you get here, or relatively soon after you get here. So that's why I call it a quasi-community property jurisdiction, because you have it available if you've come in from another state. Maybe too much tax.
Yeah.
That's good. That's good.
And it's the one-time situation, you don't need to change your mind.
Yeah, you don't waffle back and forth, and it's you really want to try to trace it back to community property as soon as you can.
Right.
Yeah.
So, in closing, I think I'd love to open it for Q&A here in just a second, but the way I look at this is that downsizing is a big event that if you control from the beginning can be life-changing and life-enabling and allow you to change how your assets serve you. And I think it's worth talking about kind of greed versus reasonable exit. And we so often find that every time someone wants to sell a house, they look at the most recent sale that their neighbors and extrapolate another 10 or 15% on top of that and say, if they sell for this, I must be here. Or I have this much in the home, so this is what I have to sell it for. The market doesn't care. And when you start acknowledging that the market doesn't care, the market is what the market is, you can try to outperform it, you can try to market the home well, you can try to present it as well as you can, but at a certain point the market is what the market is. And there's an analogy. When was the last time you bought a stock at the absolute lowest and sold at the absolute peak? And I think that never ever happens, but yet it's a common misconception that everyone wants to believe that they're going to sell at the absolute peak of the real estate market. And at a certain point, it's like trying to catch a falling knife once real estate slows down because it's an illiquid asset. And so, I think that the risk reward of waiting to maximize your returns on your house versus the potential for that to disrupt your life plans. Because if you go into an illiquid market, I always believe in real estate long term, but if you go into an illiquid market for 2 or 3 years like we just went through in Bend 10 years ago, and you can't change your life plans for 3, 4, 5, 6 years and you were planning on moving your family or whatever, what is the disruptive value to your life versus that extra 3% or 5% on a house? So I just always try to kind of remind people of that when you're considering it, just because it's just an important factor. But does anyone else have any questions, or do you guys have anything that we kind of glossed over that you'd like to bring up here? No? Well, I appreciate everyone for coming. I think it was informative for me. I've got a lot of fun notes to kind of go over, but we've got some wine outside, we've got some great food, and we're going to be here for a little while chatting, so if anyone wants to talk with anyone up here, grab a business card or get some advice, I think it would be good.
I have a question. It has nothing to do with the property itself, but what do you do with the furniture?
You give it away.
Unfortunately, furniture doesn't have much residual value. Often we sell homes with furniture as a negotiable. If you don't really want to move it, I find a lot of people simply donate a lot of it and use it as a tax write-off. It's probably better to get, if you can get any sort of tax write-off from donating furniture, it's probably going to be better than what you'd actually sell it for, right?
It's true.
And it's one call. So often what we do is if there's pieces that are kind of integral to the house, we sell them with the house. Hopefully you get some additional value on the sale, and then you call a local charity and you can do one-stop shop and they just come pick it all up in a day.
There are consignment stores in town, so there's one less than there used to be, but there are consignment stores in town where you can have them taken on consignment.
Sure. And then if they don't sell it, then they can donate it or however.
be prepared for reverse sticker shock. You walk in with a piece you bought for $5,000, you think it's worth $1,500, and they want to sell for $300.
Sure.
So it's you got to kind of remove the personal bias.
Houses appreciate, real estate doesn't, or furniture doesn't. So.